Your property's got a great loan to value and the cash flow covers the debt service. So why did your lender cut your loan proceeds by 10%? The LTV looks good. The debt service coverage is there. They both look solid and you were confident you had the deal. But what a lot of investors don't realize is that there's a third non-negotiable metric that matters even more. And if you ignore it, you could be in for a rude awakening. And it happens all the time. The phone rings and the lender calls and says, even though your numbers look good, you failed the one requirement that matters, debt yield. And to fix it, you either need to bring more cash to the closing table or the deal is dead. So what is this mysterious hidden metric called debt yield? And how can you solve for it before you talk to a lender? Debt yield isn't complicated. It's the net operating income divided by the loan amount. Debt yield is effectively the lender's version of the cap rate. If the lender had to foreclose on the property, their cash outlay would be the loan amount. So the NOI divided by their outlay is their debt yield. Ever since the 2008 financial crisis, debt yield has become a major driver in constraining how much lenders will loan on a commercial property. Because regardless of what happens in the market, the lender knows exactly how much they put out to the borrower. And if they take over the property, the NOI is their yield on that cash. So if this was the total price, if the lender loaned this much on the property, this is the loan amount, divided by the price is the LTV. That's the first metric, and that's the one a lot of people stop at. But if you're wondering why loan proceeds aren't coming in where you want, it's because you're not looking at the other two metrics. The second one is debt service coverage ratio. Every loan has loan payments, and the debt service coverage ratio is the net operating income divided by those loan payments. Basically shows how much cushion does the income from the property give us over the debt service. And then finally, and probably the most mysterious of them all, is the debt yield. And you need to be looking at all three. I'll give you an example. Let's say the property has $1 million of NOI and you're asking for a $12.5 million loan. Well, that comes out to 8%. If the lender's required minimum debt yield is 8.5%, they're going to lower the loan proceeds so the NOI achieves that yield. It doesn't matter what the rate is. It's just the income on the property divided by the loan amount. So you only have two choices. Bring in more equity, lower the loan proceeds. It's important to run checks on all three metrics before you get in front of a lender so that you're not surprised. Okay, quick recap. Debt yield is the NOI divided by the loan amount. Lenders set a floor for the minimum debt yield, and if you're below it, they will lower the loan amount to hit that number. So if you want to run this calculation on your own, I built a simple calculator and I included it in my multifamily capital strategy playbook. It's a free download, so click the link and grab it, and you can see where your deal really stands.